Thank you so much for joining us today.
Thanks for having me.
Sheila, just a couple other notes about Sheila. She's from the great state of Kansas.
Yes, I am.
Went to the University of Kansas Law School also.
Yep.
Worked for Bob Dole, another great Kansan. Is that the
indeed.
adjective? Kansan?
Yeah, Kansan, that's right.
Kansan. And also worked as a bank teller at one point, if Wikipedia can be believed.
Yes, that's true.
And then also is on the board of a FinTech company called Avant, which we'll want to talk to her about. And Sheila also is a columnist for Yahoo Finance.
Not that I am.
So I want to actually start off by asking you about the latest piece that you did for us, where you talked about the Fed actually introducing cryptocurrency and issuing a cryptocurrency. Is that really a viable idea? How would it work?
So, well, a lot of people are talking about it. I think there are two cross currents in the conversation. One is, now that technology arguably allows the infrastructure to let everybody have a Fed account. But also there are a lot of, actually people on the conservative as well as the progressive side who would like to see the Fed's largesse on interest rates opened up to households as opposed to just paying interest now to large banks. And I think it's a political problem as well as a substantive one. I just went to a major bank, I won't mention the name, to open up a savings account for my daughter. And I asked what the rate was, and they said 0.01%. Now that bank I know is getting 1.95% at the Fed. Wow. Just an example, it's not trickling down. So in terms of making a more efficient transmission tool for monetary policy, if you want people to save more and spend less, which is what you're trying to do, if you're worried about an economy overheating, paying the interest directly to them, as opposed to trying to do it through large banks where the transmission doesn't go down into the layer of the population that are making the consumption decisions. So I do think that there are some advantages in terms of monetary policy. There's some huge disadvantages and transitional issues as well. But the private sector may force the central banks, the Fed's hand on this, because there are a lot of startups now investing in stable value, cryptocurrency. Bitcoin's not been stable value, so it really has not become a widely accepted method of payment. But there are a lot of startups out there trying to create that stable value cryptocurrency. And if and when they do, you could see a lot of money moving out of the banking system into crypto, I think, because, everybody hates bank account fees, the retailers hate interchange fees. If there's a way to get around that, I think you could see a shift fairly rapidly. So I do think the Fed needs to get ahead of this and get their arms around and explore whether they should offer something of their own before this dynamic happens, which could not only provide a serious disruption to banking, but also to their ability to control money supply. And
you have a name for it.
FedCoin, yeah, well that's not my coin. A lot of people have used that. Yeah, I can't claim ownership of that, but yeah, it's got a nice ring to it, doesn't it?
It does. I mean, is there any chance of this happening, Sheila, do you think, at any point?
Not in the near term, no, I don't. But there are a lot of central banks studying it already. And as I said, there's a lot of smart money going into trying to develop a stable value cryptocurrency. So, in the next 10 years, I think you're going to see some significant transitions in this area.
It sort of speaks to a bigger point, a bigger issue, which is the overall regulatory framework of blockchain and crypto. And could you, to the best of your abilities, describe what you think that is currently by the federal government, and where you think it's headed, and what do you think it should be? It's a lot.
So what the regulatory framework should look like?
So in other words, what's the regulatory framework now?
Right.
Where do you think it's headed?
Right.
And what do you think it should be if it's different from where you think it's headed?
So I think you have, so I'm also on the board of a company called Paxos, another financial technology company that that's developing blockchain technology for post-trade settlement in certain different asset classes. And so I just want to get my flag up on that as well. Yep. Look, I think, and it also owns a small Bitcoin exchange. I think we're trying to kind of jam, let's just talk about cryptocurrency trading right now. We're kind of trying to jam that into state money transmitter laws, basically. It just doesn't work. And I think at some point we will need a federal framework to have some type of regulatory oversight over exchanges that are established to trade crypto assets. They may also be securities. If they're ICOs and they're being used to raise equity, they need to be regulated as securities. I think you need to look at the functional use of it, and some crypto assets will be functionally equivalent to currently regulated financial products. Others will be completely new, which is why I think over time we will need to create a new framework just for crypto assets. But right now, you know, I think the regulators get a bad rap on this. You know, people, the SEC, the CFTC, the New York DFS, they regulate Paxos. I think you've got a lot of fairly sophisticated regulators looking at this and trying to stay ahead of it. But I do think trying to jam this into state money transmitter laws is very awkward, and at some point we're going to need some type of federal framework. I think that's probably going to be several years down the road as well, but it needs to happen.
I mean, you know, we've seen the price of Bitcoin, 19,000, 6,000.
Right, yeah.
And, you know, you were saying to me before we came on stage that, you know, you'd be concerned about this as sort of just an asset for consumers to just buy and borrow on their credit cards to purchase that, right? Yeah, no, I don't own it. I think retail investors should stay away from it. It's highly volatile. There's a lot of product out there, probably 95% of it's not going to go anywhere, you know, so I think Bitcoin's proven it's got staying power. Ether, Ripple, some of the ones, the more established ones are out there, but there are a lot of new ones that I would be very skeptical of. And even the established ones are highly volatile. So I think it's for now it should be an institutional market. But there again, an overlay of regulation might be able to create a framework would be more adaptable to a retail investor with all the kind of protections you have now, for instance, for publicly traded stocks. But we don't have that right now. Right. I mean, I mean, you mentioned that it does seem like some of the agencies do have their brain wrapped around it. The SEC just last week at our event in San Francisco, Bill Hyman said that you know, that Ether and Bitcoin are not securities. Saying that again, right? Yeah, I know, and I think I read that speech. I thought it was very thoughtful because it's not on currently traded cryptos, because if they're anything, the closest thing there to is probably a currency. And so if they're not being issued, if they're being issued to raise equity capital for a new venture with a promise of return, then I think he was very clear that it probably would be a security. But the currently traded, those two at least, the currently traded ones now are not performing that function, so shouldn't be regulated as securities. I thought it was good that he would clarify that, and congratulations for you guys getting this. Oh, well, yeah, I mean, it was interesting to watch the price spike, right? Right, So let me ask you about Avant, the other company you're on the board of that I mentioned before, this FinTech company. What is the business model? What do they do? So they're a marketplace lender. I knew people who had invested in them, and they had approached me about serving on the board, and I was attracted to it because they try to serve it's unsecured consumer lending. They use marketplace funding. They're not a depository, but they're trying to serve that near prime population, the underserved population. You know, we have a lot of lenders out there who are happy to, you know, skim the cream off the top, and people that have their high FICO scores and plenty of income and are quite creditworthy. There's a lot of competition for those borrowers, not so much in the near prime space. And here again, using technology, using AI, trying to come up with a better variables and considerations to underwrite those loans to that near prime customer. Under traditional criteria, it would be near prime in a way that's affordable. So that's what they're trying to do. And you know, there are challenges, but I think it's worth the effort. When I was at the FDIC, and then formerly when I was an academic, I did a lot of research on this. And unsecured consumer lending is very high cost. We have there are a lot of reasons for the smaller loans banks. It's expensive for them to underwrite it, so they don't do a lot of lending in that space. Small bankers more than big banks. And marketplace lending, I think, does have a role. The Philadelphia Fed did an interesting analysis of lending club data last year that actually showed that the marketplace lenders were expanding access to credit, prime credit, to those who otherwise would be denied credit or be charged a subprime rate. So I do think technology over time can help us get smarter about making loans to people, but loans we know that they can repay. The worst thing you want to do is make a loan to someone who they can't repay. We learned that during the financial crisis, I hope, that you don't do anyone any favors by giving them credit that's not affordable to them. Right, so I mean, the analytics that your company, the company Avant, and others have, you know, the hope is that the model makes the system less fragile then, right? Yes, that's right. Yeah, I mean, it diversifies sources of credit, and then again, expands credit in a way that's affordable.
So yeah, I think that's the promise. And then also, the other thing that was interesting about the study is that it looked at areas, especially rural areas, where bank branches had closed, and found that marketplace lenders were helping to make up the credit deficit once the branch closed. And of course, we're seeing a lot of brick and mortar going away and some of the larger institutions pulling back in rural areas. So I think that's another advantage, that since you don't need to rely on a geographic location, you really can make credit nationally available.
Yeah, I didn't even consider rural areas,
Right.
because you typically think maybe of urban areas when you think of that sort of lending. It's interesting.
Yeah.
Let me ask you about FinTech. Let me ask you the same question about FinTech that I asked you about crypto, which is to say regulatory, and do the regulators have their brains, collective brains wrapped around this, nascent, incipient business?
Right.
And what's going on there now? I mean, there's, a lot of companies are getting venture money and starting up and then trying to avoid specific oversight by regulators by saying, oh, we're not a broker-dealer, but basically we're doing broker-dealer activities or that kind of thing, right?
Yeah. So look, I welcome regulation. I think it will, a well thought out regulatory framework will help this industry grow. I think and it'll weed out the bad players. You want to weed out the bad players, because then the whole thing gets tainted and you create problems for yourself. So I do think that it needs to be regulated. I think regulators need to be wary of regulatory arbitrage. So, calling something financial technology or innovative just to avoid regulation is not really a good use. And so you should look at the technology. If they're performing a basic securities function or banking function but not being regulated as such, where's the value added? Is the only value added that they don't have the regulatory cost that a regulated bank or regulated securities firm would have? And that's, I think, a bad use of technology. So you need functional equivalence. By the same token, to the extent some of the regulations don't neatly fit some of these new innovations in technology, perhaps we need to adapt the regulatory structure, but then we also need to look at the legacy institutions. Well, maybe those regulations we don't need the regulations there either. So it hopefully can pave the way for some smarter rethinking of how we regulate, but you do need an even playing field and avoid arbitrage. If the only reason the technology exists is to get around a current regulatory framework, that's a bad use of the technology.
I just heard you say you're pro-regulation to a degree, and you're a member of the Republican Party.
I am.
Right?
Yes, I am. Yes,
I mean, to be clear.
That's right. Smart regulation.
Right. A rare bird, perhaps. So you were talking about the legacy institutions, and I want to ask you about that, because obviously that's front and center today, with, let's just say, the rollback of Dodd-Frank. And, we've seen some of that. I gather that you're a little concerned about that rollback. But
yeah, very concerned, yes.
Well, talk about that, and maybe I want to push back against that a little bit.
Yeah, okay. Well, look, this cycle is very long in the tooth. We're 9 years into this recovery. It's not been a strong recovery. It's been a very uneven recovery, and I think we're probably seeing the last spurt before it turns again. And we've just got a lot of these financial reforms in place. The ink's barely dry on some of them. Some of them, like capital and liquidity, which are the two most important, there was uniform consensus that banks were too highly leveraged. They relied too much on borrowed money, and they relied too much on short-term borrowed money, which made them highly unstable when the crisis occurred. So we've tried to fix all that, and to undo that now, when these reforms haven't even been tested through a cycle, I think is very ill-advised. And if the Fed is worried about an overheated economy, and clearly they are, that's one of the reasons why they keep raising interest rates, there are other tools you can use too. I mean, you want to tighten regulation a little bit. You want to tighten credit standards a little bit when you sense that things are getting frothy. So to be deregulating on the one hand and raising interest rates on the other doesn't make a lot of sense to me. I think they should be tightening credit standards a bit, and I think they should require banks to continue to build their capital buffers. The next downturn could be, a normal cycle, or it could be another severe recession. And it will be a severe recession if the banks are ill-prepared again. And so if they have too little capital, if they're over-leveraged, they're going to have to pull back on credit, which is exactly what happened in 2008. That's going to hit the real economy again, and we're going to have severe problems. So I think we want to avoid that at all costs.
But are they really talking about capital requirements or just sort of regulatory box checking? I have a friend who works at Credit Suisse in compliance, and she told me that she spends most of her days going green, red, green, and she says it's just really kind of a worthless exercise.
Well, there are a lot of different, so there's rules on, yes, they're easing the capital rules, they're easing the stress test rules, and they're easing the compliance requirements on the Volcker rule, which is probably what your friend was talking about.
Right.
I think on the capital rules, they've said it will release $120 billion out of the 8 largest insured banks. That's about a 20% reduction. And then there's a dispute about, so that money, but the Fed says that money will still stay in the holding company. So the holding company in which the insured bank resides will still have to keep that capital. Goldman Sachs has an analysis that says no, that actually at least 50 billion or so is going to be released. I don't know why we want to release that amount of capital out of the banking system right now, given the uncertainties of the economic cycle. They are making every loan that they want to make, they are making now. They are profitable, their shareholders are getting ample distributions. Why in the world do you want to weaken those capital cushions instead of continuing to incrementally strengthen them? At this point in the cycle, it just makes no sense to me. And we're reading too, and I think this is accurate, that this round of stress tests are going to be allowing banks to pay out more in dividends than they've earned, right? So that means if you're paying out more than you earn, you're reducing your capital buffer, and that makes no sense to me either. So I really wish we would have more caution. Again, if banks are struggling, if we were seeing credit shortages, it would be one thing. We are not, just the opposite. If anything, there's too much credit out there right now.
Yeah, and I guess kind of a weak argument would be from the standpoint of, let's say, JP Morgan, yeah, our stock is up 300% since 2008, but it could be up 450%.
That's right.
Right? I mean,
yeah, that's right. Was it "Don't be greedy"? Is that?
Well,
yeah, okay, right now, yeah, exactly.
It's kind of maybe not the best way to get things accomplished,
No.
I guess. But the non-money center banks is where they've gotten some relief, right?
Right.
Does that
they
make
have
sense?
the smaller banks. Yeah, and I think that was we probably did cast the net too wide after the crisis with the smaller institutions. Those smaller institutions are still regulated. There shouldn't be any question about that. There's just this enhanced prudential framework will no longer automatically apply to them. And I actually think that will help. We get a little better trained regulatory resources on those very largest 8 or so banks. They're truly systemic, that we know if one of them gets into trouble, with Citi or JP Morgan Chase or Goldman, whoever gets into trouble, you're going to have some serious problems. A BB&T, it would not be a good thing for a bank of that size to get into trouble, but you can handle it. We've handled failures of that size in the past without systemic disruption. So I actually think that piece of you're referring to the Crapo bill was fine. Now the Crapo bill also loosens the capital rules for so-called custodian banks. I think that was ill-advised, but that was in there too.
Without passing too much judgment on the current administration, you could say perhaps the White House is dysfunctional. You might be able to say that. But say, in terms of the financial parts of the government, Treasury, Fed, other agencies, are those, Sheila, to the best of your thinking, are those being well managed right now? Is it sort of business as usual?
Yeah, I think, well, certainly the Fed. I mean, the Fed's got very thoughtful people on the board, very good staff. So we may have some different views on some of the policies they're pursuing now, but I think in terms of administrative execution, you have a high level of competence. And same at Treasury. I was Assistant Secretary for Financial Institutions at Treasury in the early 2000s. It's got top-notch career staff, very loyal staff. I think Steve Mnuchin is a quality, smart person. Craig Phillips is a domestic policy advisor, is a very bright and experienced person. So even though on policy I disagree, I don't think, at least in those two agencies, we need to worry about the competence of the administration of them. No.
Interesting. But I do have to ask you about the Consumer Financial Protection Bureau. Yeah. And that has been an interesting little drama that has been playing out. Mick Mulvaney was here yesterday, I understand. And so is that being defanged, and is that going to cause harm to the country? Yeah.
Well, I worry that it is. I mean, I think the perception, at least, the public perception, and there are reasons behind that public perception, is that it is not a champion of the consumer anymore, that it's kind of shifted to industry protection, not consumer protection. And I hope that's wrong, but look, that agency was created because there were some serious shortfalls in consumer protection leading up to the crisis. The lack of lending standards, the Fed, you know, and Ben Bernanke and Alan Greenspan have both said that this is a mistake. The Fed had the authority to write consumer rules on affordable mortgages, just flat out didn't want to do it. And if they had done that in the late 90s when this craziness started, I think we could have avoided a lot of the heartache in 2008. So that's water under the bridge, but I think Congress rightfully looked at this and said consumer protection is sufficiently important that it can't be buried in the Fed or some other agency, the FDIC, whatever, that's, you know, that's really into safety and soundness and close to banks. And we need a specialized agency that will just be the advocate and protector for consumers. So that's why the CFPB was created. There was a good policy basis and need for the CFPB. And I just hope Mr. Mulvaney, or whoever the future leadership is, will understand that history and purpose. And, you know, I'm a Republican, and you know, people have different views about whether you emphasize disclosure and enforcement, whether you disclose, you know, you emphasize rule writing to protect consumers, so people of goodwill can have those discussions. But I think what we can't disagree on is that the purpose of that agency is to protect consumers. There are information asymmetries that, you know, financial service providers are always going to have more information. There have been a history of abuses and problems, and that agency needs to protect consumers. That needs to be their focus.
It shouldn't be the Industry Financial Protection Bureau.
No, it should not be.
Right.
No, please.
Was there enough bipartisan support when it was introduced, though? I mean,
No,
otherwise, was it just inevitable that when a Republican administration came in, they would just kill it?
Well, it was, and that was unfortunate. And I think I was very involved in Dodd-Frank, and I was hoping that they would have structured a little differently with the board instead of a single director. Because I think kind of the challenges we're looking at now, that's one of the reasons why I was worried about having a single director. You're kind of all in on that one person. And I think a board structure would have been more attractive to some of the Republicans. I think the funding structure, kind of having forced funding from the Fed, that was controversial. But it is disappointing because consumer protection shouldn't be partisan. And I think there are moderate Republicans with, you know, maybe a little bit of a different structure could have supported it, but that just didn't happen. It got very partisan in Congress, and that's continued.
So a board, you have an odd number board, five
right.
people,
So like
and you get three with a Republican, or three when it's a Democrat.
Yeah, that's typically right. So the FDIC had a 5-member board, the CFTC, the SEC, the Fed has 7. Most of them are mandated to be politically balanced. The Fed actually is geographic balance. But yeah, you get more continuity with a board than with a single head.
Was that didn't happen because the Republicans didn't want it to happen because it's easier to kill it, do you think?
No, I think the progressives didn't want it. The people that were backing it didn't want it. I think their fear, they looked, you know, that there were some fairly severe partisan divisions going on, especially at the SEC then. I think they looked at that and they were afraid of having a politically divided board. So to put it all, you know, with one person, and that was fine when President Obama was making the choice of who was going to head it. But I think they were thinking short term and not long term.
Yes.
What would happen if somebody else that wasn't as supportive of the CFPB was going to be appointing that new head?
Right, right.
Yeah.
You mentioned the cycle, and we're late in the cycle,
yes,
and we're maybe staring a downturn in the face. And I want to ask you what you think of the administration's handling of the economy right now in terms of the Fed and Treasury and where we are.
Well, look, I think we're pouring a lot of juice into this, and I don't even know if we're going to make 4% this year. You know, I supported the tax cuts, but I thought you could have paid for the tax cuts with true loophole closing. I mean, remember Simpson Bowles? I mean, that was kind of, there were any number of plans to show how, and you know, you can reduce those marginal rates, get some stimulus without having to finance it with deficits through loophole closing, because loopholes are a drag on the economy. We didn't do that. So we created some new loopholes with these pass-through provisions. So you've got a very expensive tax bill that's providing some juice now. How long that will last, I don't know. And then, of course, the budget deficits are increasing too on the spending side. So it's like, you know, I don't think it's sustainable. And there again, if we start deregulating the financial sector as we're providing all this short-term deficit stimulus into an economy, then we're going into a cycle, and our fiscal resources will be constrained. There won't be sufficient bank capital as well. So no, I wish they would think a little longer term. I fear that we're kind of regulating to the election cycle, not the economic cycle right now. And I think we need a little more long-term thinking. definitely.
All right, well, I guess it would be appropriate for me to say, Sheila, that that is food for thought, because I am about to tell you all some great news. It is time for lunch. But first, please join me in thanking Sheila Bair.
Thank you.
So please enjoy.
Thank you.